Good afternoon, everybody, and thanks very much for joining this, our latest Nest Insight online event on strengthening retirement systems, a view from the United States. So we're delighted to have many of you joining us today. I'm just going to kick off really by saying a few words to try and introduce the session and set the scene for today's discussion. So as some of you will know, Nest Insight has a strategic partnership with the Aspen Institute's financial security program going back a few years now, through which we do joint work on mutual areas of interest, but also try and kind of highlight and showcase each other's work, where we think that work will have relevance across our two countries and systems, between which there are obviously a huge number of parallels as well as some important differences. One area that in particular we share a real interest in is this whole question of the sort of broader issues around people's financial resilience and security and financial well-being, and how different parts of people's financial lives interact with each other and then impact on specific parts of their financial lives, like in our case, often retirement saving. So the purpose of the session today really is to highlight the excellent recent work Aspen FSP has done in the areas of financial security and pensions policy, more specifically, especially against the backdrop of the pandemic and the impact that's had on people's lives. And also to hear a bit more from Ida about the state of the policy discussion in the US, particularly with respect to retirement saving, where there's an ongoing debate about tackling some issues similar to those that we've tackled here through the auto-enrollment programme. So on that note, I'm really pleased to hand over to introduce Ida Rademacher, who is the Executive Director of Aspen FSP and a good friend and long-time collaborator of ours at Nest Insight. Ida's going to take us through some introductory remarks just about the work of Aspen FSP and their work just over the last year on financial security. And then we're going to open that up into a discussion, which will be partly Ida and I in discussion, talking about some of what Ida discusses, and then also building in your questions from the audience as they start to come through as well. But without further ado, then, Ida, over to you.
Thanks, Will. It's good to see you. It's early here. I'm in Aspen, Colorado, which befits the Institute. We've just started to open back up again, and it's been great to be able to be out here for the Ideas Festival. But I've actually been looking forward to this panel and a conversation with you for a while. So thanks for inviting me, and thanks very much to everybody for joining in. I'm happy to share a little bit about, and I will say a little bit about the financial security program, because I really do want to get into, Will, the ways that we've built out our understanding of financial security holistically and how we think about what it takes to do that for a household. So, for those of you who don't know Aspen, we are the program, the financial security program, has been around for quite some time. I've been here for about 6 years, and the primary focus for the first decade was the retirement savings system. I like to say to Will sometimes that the U.S. is a great net exporter of ideas about how pension systems should work, and oftentimes policy implementation in the U.S. is a little bit slower, but we get to see where these ideas go when we partner with groups like Nest, with organizations like Nest Insights. When I came to Aspen, part of the goal I had was to try to connect the dots between the conversation that was being had in the pensions field, in the retirement space, around really, if there was some questions about access, but a lot more about how does a DC system work, and how does it accumulate, and how do you make sure that everybody who's in the system can grow their savings. But there was a big disconnect between that and how the financial lives of Americans were changing, and how in touch the retirement system was with some of those indicators. So we spent a lot of the early years when I came here connecting the dots between income volatility and people's, what was really going on in people's financial lives. So we've spent a lot of time on issues like income volatility and consumer debt, things that are disrupting people's short-term security, so that when we build policy and we build product for long-term financial security, it feels relevant and connected to what's really keeping people up at night as well. So in the 5 years that I've been here, we spent some time at the end of last year looking across all of those critical financial challenges facing American households and trying to distill that into a new financial security framework. And that's what Will is showing up on the screen right now. So it's a lot of words, so I don't just look at the basic house. I think the main thing, we'll start with two things, and I think this is pretty aligned. We'll jump in at any time. When we think about financial security, we really adopted the Consumer Financial Protection Bureau's definition of financial well-being as that. So the 4 components there, and I did a lot of the research with that work in my prior job. We went around the country, different states and different demographics and different age cohorts, and the 4 principles that really came out of that consumer-driven definition of well-being was, I want to be in control, feel like I can manage my day-to-day. I want to be able to be resilient in the face of an economic shock. I want to feel on track to reach my long-term financial goals, and I want the opportunity to take advantage of either the little things in life or the big things in life as I choose. And many times that would come out from people talking about, I want to be able to just send my kid to summer school, or I'd love to just go out to dinner without thinking about it. So we kind of boiled that down to this idea of people want both security and freedom. They want both security and choice. And so with that as the backdrop of the definition, we have created measures of financial well-being. But what it really takes at a household level is what you see on this slide here. In our mind, it has come down to 3 things. First and foremost, for financial security, people need routinely positive cash flow, which in some ways is a no-brainer. But in reality, that is really what trips people up from being able to be savers and to build long-term security. And that routinely positive cash flow, we've become a bit agnostic. That comes from your wage labor, but it also comes from non-labor income, either from the kinds of benefits you receive or any kind of other kind of transfer. And you get that routinely positive cash flow both by increasing that income, but also by managing and making expenses manageable. So, and then from there, along with routinely positive cash flow, personal resources, and then alongside that, a really important third pillar, public and private benefits. And so we've really moved into this holistic definition. And I would say that the way that the pension system comes into it, you can already start to imagine, especially with the UK and in some of the states in the US where we're seeing automatic enrollment growing, when you've got automatic savings, that's really important. But of course, it really matters that you've got consistent positive income to make that work. And so that's some of the tricky parts about emergency savings that we can talk about later. But we can also talk about some research we did during the pandemic that showed that incredibly important resilience impact of emergency savings. And a lot of the work we're doing right now in the US is around this public and private benefits piece, which is really understanding what's the next generation bundle of benefits that households really need to have that level. Like you can self-insure for so much, and that's the importance of emergency savings, but there's a lot of things you can't self-insure for. So at least in the US, when we saw the pandemic and the need for unemployment insurance, the need to figure out how to have public benefits and employer-based benefits talk to each other so that people are getting what they need on a day-to-day basis so that they can live dignified lives and stay productive members of the economy and fully participate. So that's really some of the background of the framework. We've been using it to apply it to a lot of domains of our work, but the pensions work especially is someplace where we continue to look at the intersections between these other pieces of people's financial lives and how we really can help them save and invest and shore up the retirement savings system in the US.
Great, thank you.
Sure.
Ida, that was great. And I mean, as we talked about before, I think this framework is great and works incredibly well to illustrate some of the issues that we've been really interested in. I guess, I mean, I've got a whole bunch of things I'd love to talk to you about on this, but maybe just to kick off, this framework encompasses a lot of stuff, right? Stuff which is worked on by different organisations and different communities of interest, and on which there's good data in some places and less good data in other places, and that completeness of the framework is a strength, but it's also kind of terrifying, right? Because how, as people who are trying to figure out how to kind of design new solutions or help people with aspects of speech, how do we ever kind of understand enough about what's going on to kind of hone in on the things that are really going to going to help. And you will hear sometimes, I know this has happened in the States, and you get bits of it here as well, people talking about maybe auto enrollment isn't the right thing for some people because they should be focusing on some other part of this picture first before their pension savings. So how do you guys think about kind of that trade-off between keeping the big picture but not letting the complexity of that picture get in the way of kind of making good progress on actual tangible stuff that's going to help folks?
Yeah, it's a good question. I mean, I think part of that's the humility of who Aspen is in a much bigger ecosystem of both researchers and also providers in the US. And I think at this moment, it's important that for us as an institution, what we hold in the center of the conversation is, the messy financial life of an individual, which isn't very, it's not very productive to compartmentalize for them. Medical debt over here, rent's taking up 50% of my paycheck. I'm a gig worker, so in some ways we try to hold the center of a conversation about financial security, and we build, but you can still build unique problem sets that different providers in the world and different researchers want to go deeper on. So a lot of what we try to do is a catalyst, and also a little bit of making sure that people don't get too comfortable just talking to people in their own niche of the financial security field in a way that potentially starts to remove them from how people's financial lives are changing. So I would say for us, part of it's just been pacing ourselves. So when we started on something like consumer debt, we took 2 whole years to both boil the ocean of what do we know about the dimensions and drivers of consumer debt, and from that, build a solution framework and think about the specific actors that needed to be connected to. We didn't really spend a lot of time within that context. The first thing we did wasn't try to pull everybody in. We spent ourselves, if you looked at the box, we spent our time in that way that debt interacts with personal resources, consumer, routinely positive cash flow. And no surprise, and we'll find this later, in the US, medical debt is really one of the biggest issues. What's interesting though, if you do go ahead and go around the clock of somebody's financial life, some solutions continue to stand out regardless of the problem. And that's why things like we've been working on together, emergency savings, wow, that's come up as part of the strategy, whether we were looking at income volatility, whether we were looking at consumer debt. And now when we look at retirement savings, when we look at the insulating effect and the way that it buoys financial well-being, even if you have retirement savings. So I would say that for us, part of where are the durable solutions comes from not holding ourselves into one part of that box. But yeah, it can get a little bit unwieldy, and we're not expecting an audience to take it all on. Everybody already kind of has a swim lane in many ways. But for example, another place where that's expanding, Will, is payroll providers. So the payment system has been a totally different thing forever than the retirement system. But as you start to build out interoperable platforms and you think about automatic enrollment, the payroll system and the payment system becomes an incredibly important part of solving for retirement savings as well.
Yeah, no, I think that's fascinating, Ida. Really interesting observations. Thank you. You mentioned your own research in the kind of COVID space, and obviously the pandemic has had a profound impact on people's financial lives. Just tell us a bit more about what you've seen in the States, both I guess in terms of impacts on broader financial resilience and anything specific to the retirement system. What's the discussion been over there?
Yeah, it's a very lively discussion. There's a lot, as we probably talk about later, there's a lot of policy movement on emergency savings adjacent to retirement savings and otherwise. I would say the best pulse that we got during the pandemic is some collaborative work we did with Morningstar and the Defined Contribution Investment Industry Association and University of Chicago, where they were able to really look at data pre and post pandemic. And we were able to build in questions, not just about your retirement savings and withdrawals, but also emergency savings and debt. Because again, you actually can't figure out the whole picture unless you know as you've always talked about, like both the consumption and the debt and the retirement. So what was really interesting, retirement savings, people who had retirement savings, most people didn't touch it. And in the US, it's more accessible, it's more leaky than the UK. But even so, most people didn't touch their retirement savings. But whether or not they had retirement savings, emergency savings was the barometer of financial resilience. And the amount of emergency savings going into the pandemic was highly correlated with financial resilience and well-being getting through the pandemic. And that was whether or not you had retirement savings. And it was, and that was irregardless of your income level. Now, those without that savings did far worse in terms of their well-being through the pandemic. And when we did see people diving into emergency savings or something else, it was a medical debt issue. It was in the US, you know, a lot of people think that it's payday lending, and it is, but the biggest two impacts on people's financial well-being in terms of debt load has been in the US, student debt and medical debt. So obviously we saw that the kinds of cash transfers, the pandemic transfers, played another important insulating effect. So that also reinforces the idea that personal resources plus benefits are part of what you know, really helps somebody navigate those short-term shocks in a way that doesn't set them back 5 or 10 steps when we come out of the piece of it. So I think in all, people are just beginning to be able to connect the dots between the data we're finding from the pandemic and long-term, you know, that well-being. But those early signs were really extraordinary. And you know, I'd be remiss not to say in the U.S. Huge disparities by race in terms of people's ability to weather those shocks and have access to either personal resources or benefits. And so that was true. But the other side of the coin was that you know, we track unbanked rates, just generally kind of people's access to the financial system. And a lot more people got banked during the pandemic. So, you know, like huge jumps in the level of banking for African Americans in this country. And, you know, for us, part of that is just realizing sometimes that you get an account when you have money to put in it. You know, and so people had cash transfers going. So if we want to raise the bank rates, if we want to raise the retirement rates, let's make sure people have enough income to put into those spaces. That's another kind of takeaway, I think, from the pandemic.
Great. I want to just maybe focus a little bit on something you touched on a couple of times already, and that is also a big part of our work, which is this idea of the link between kind of short-term saving and long-term saving. And you talked a bit about the kind of idea that people who have that kind of shorter term financial resilience, who have the capacity to draw on some emergency savings, you know, maybe in a better position to be able to save for the longer term and for retirement as well. I just wonder if you could say a bit more about, I mean, firstly, any more kind of data or evidence you're aware of that helps establish that link, but also just about the context in the US, kind of how well accepted is that premise that there's a connection between those two things?
I mean, in some ways, those are different questions. So let me take the first one first. Some of my favorite data points, some of them are new and some of them are older, around the importance of emergency savings. The two things I'll say, one is a piece that the Urban Institute did quite a while ago. In my old job, I used to work for a group called Prosperity Now, and we had something called liquid asset. We had asset poverty, which was if something happened to you tomorrow, could you survive 3 months without without having to go into debt? That was a big number. That was $3,000, $4,000, $6,000 depending on the years and the median. This was a while ago. So liquid asset savings, liquid asset poverty, was that question about what percentage of the population doesn't have $400 or $500. But what I still say, sometimes that's like working with mittens on. It's like working with data with mittens on. You still don't know. So the question that the Urban Institute tackled was, I kind of wanted to know, what's the minimum effective dose of savings that fundamentally changes somebody's ability to recover from a shock? And so I won't get this exactly right, but we can follow up and give this to you and attach in the notes. But they looked at a lot of data and kind of came up with this sense. It was less than you thought. The range was like $200 to $700. And when they looked at people who had that amount of savings, people who had that amount of savings that were in the lowest income brackets actually recovered from economic shocks better than people in a higher income bracket that didn't have any savings. So there was that kind of a recovery piece to it. And then the other piece that I would say that really, for me, is the evidence that says why we should really spend our time on emergency savings is because when we have the scale for financial well-being from the Consumer Financial Protection Bureau, and the single most powerful correlate to financial well-being on their measures is liquid savings. And we saw that again, we applied that measure in this most recent Morningstar research, and liquid savings again really was the thing that came out as that most fundamental factor. Now, a lot of people with liquid savings also have, like we said, other access to other kinds of benefits. Maybe they have paid leave, maybe they have a regular schedule, maybe there's health insurance there too. But regardless of those things, even when you control for them, it does have the most explanatory value for what drives financial well-being, both subjectively and objectively. I think when it comes to how well is that understood in the U.S., more and more, I think it's no longer just a few organizations trying to say something and like dropping a pebble in an ocean. I think you see it a lot in the mainstream media. You see a lot of the conversation being driven by asset management and retirement and pensions firms. So for me, those are indicators. And I think also, and I'm sorry, I'm talking way too much. I think the other thing that's nice is I think there's less pushback that, for so long, it was just this question in the US, oh, the poor can't save, or maybe they shouldn't save. And I think that when you actually strip the paternalism off of that and you talk to any family, they want to save, they want to invest in themselves and their futures. And we should be trying to figure out what the tools are that give them that ability.
Great, and don't apologise for talking too much. I mean, that's the whole point of the event. I guess for people to hear from you. They've heard from me plenty of times before. So I remember, way back many years ago, the idea for an automatic enrollment program as a public policy intervention was kind of born in the US, I guess, in the middle of the first decade of this century, or sort of 2006 time, wasn't it? We're back with the kind of auto IRA proposal, and then I remember one of the first things that you and I worked on together, and Jeremy, your former colleague, was a big event in Chicago where we sort of came over to talk about how that idea had been kind of implemented in the UK and how that was going, because in the meantime, as you describe it, the good net exporter of ideas, but not always as easy to actually then get kind of traction on the policy side in the US. So it'd be great to hear about kind of where things are now, I guess, both on retirement policy and also on emergency savings policy. I know those are both active debates among policymakers. So where have things got to, and what might we see happen in the next few months?
Well, this is another place where there's folks with a lot deeper knowledge of every up to date change in the retirement automatic enrollment space in the US than me. But for broad brush, let me just share that there were people listening. There are people listening in the US, so it is other countries, but it's also in the US. And at the state level and at the local level in the US, that's where your government leaders, they have a lot of the downside risk of individuals not having financial security is that it impacts the budgets of state and local entities in a much more material way sometimes than at the federal level. So they get it. And so state treasurers really in the US, California, Oregon, were some of the first places that said, well, and this is of course America, laboratory of the states, let's try it here. Let's try automatic enrollment. Let's try the mandate, the kind of specificity of it is that the employer must enroll employees, if that's and they have different states have different thresholds of how many employees. Employers can opt in or opt out. So the difference from what you have in the UK is that it is an auto IRA. The employer is not putting any funds, not matching any funds into that. The government isn't matching any funds into this. So, but as a new kind of floor, then nothing. We are finding that the automatic enrollment default is sticky, and that the in states that have now been doing this for 3, 4, 5 years and longer, really in terms of what the enrollment process is looking like, very, you are seeing some folks decide not to enroll, but those numbers are jumping like you see in the UK. 70% versus 20% now have that. So you're expanding access, and at this point, between the states that have an on-the-ground plan that is growing and the ones that have enacted legislation, I think 37 or almost 40 states have enacted or are looking and doing studies. And the states that have put something in place have the potential to provide a base of retirement savings through their plans for about 20 million Americans. And there's about 50 million Americans right now that don't have access to workplace retirement savings. So even on this state-by-state initiative basis, that's huge growth in the last decade. And there's just an incredible set of leaders at the state level and now at the local level looking at this. And of course, that has then driven the attention at the federal level as well, because once you have that many different, I liken it sometimes to in the US when states had different standards for gasoline, and an oil company would say, I have to deal with 50 different kinds of, like ways of putting gasoline out to meet these different criteria. I think over time, people are seeing both from the market side and from just the public policy side that this is a national conversation, and we need to have a solution that will work for all workers if we're really going to get ahead in this country. But it's exciting to see it happen, and it's exciting to see the growth of interest right alongside that of how does emergency savings get built in from the start, either inside of the plan or adjacent to it in a way that, and that's really where a lot of the research agenda will come in the future. For us, there's a lot of regulatory complexity about how you would make those two kinds of accounts work because they're regulated by different parts of the government. But for somebody's life, even if they're separate, can you create the technology and the skin on the front of that where the experience of having both emergency liquid savings and retirement savings helps somebody see their full financial life?
Great, thank you, Ida. Several more things I'd like to ask you about, but I'm just going to remind people who are listening in, please do throw any questions that you would like to hear Ida's views on into the question functionality of the platform. We'd love to get to some of your questions as well, but I'll carry on for now. So, be interesting to just talk about kind of what you see as some of the other live issues in the retirement system from a policy perspective. I know that there are some similar discussions there to things we're talking about here, like portability and how to deal with the sort of proliferation of lots of small accounts in it when you get that auto enrollment mandate. I know lifetime income, self-employed and the gig economy, those are issues on the horizon there, like they are here. So just tell us a bit more about kind of what the issues are in the States and how you see them kind of playing out.
Yeah, but I mean, I can't skip over without just stating that we still don't have universal access to retirement savings in the US. So we're trying to, in parallel, not let that trip us up from, like, even access is not the silver bullet. Accumulation is so important. And of course, if somebody's job tenure these days is 2 years, not 10, the questions of portability become something that we need to solve sooner versus later, even as we're working toward everybody having access to a retirement system like you do. So portability is definitely one that's on the horizon for us. And we've been thinking about it in new and different ways as well. The more we engage, not just with people who are thinking about other benefits, and we're thinking more about interoperability, like what is the way that technology is it really about porting it, or is it really about, like, you're working so hard on a dashboard, how do we from the get-go try to not get people so separated from their accounts? What's the role of just visibility and interoperability between companies, about how things can move? So there's a lot of important new thinking in the portability space that needs to be done, and luckily we're seeing people up for it. I think we continue to look at the interactions in the US between student loan debt and retirement savings as well, especially as employers, and the whole conversation about what's the future of benefits. There's some ways here that that becomes an important piece of it. The lifetime income part is interesting because we just talked earlier about routinely positive cash flow being the basis of well-being, whether you're in your working years or your retirement years. And there's been this kind of growth of people talking about basic income in your working life. We've been talking about it in retirement forever in terms of how do you annuitize, what's cash flow, what's lifetime income. And so we're actually kind of thinking about these are very different people thinking about kind of cash flow. Could this potentially bring new innovation about what are the tools into a very long-standing conversation about cash flow and retirement? Like, is there a way that we could think about the life course and the need for income, and think about all the different ways that we solve for that? So it's not a silver bullet, but it's an interesting way to revitalize a conversation that often feels, at least when you're dealing with issues of low-income savers and low-income workers, you can often feel tone deaf if you're talking about how do you make sure your retirement savings lasts, and people say, oh, what a nice problem that would be if that was the problem I had. Kind of focusing on lifetime income and now having some empathy for that in the working life too, with the growing work on basic income, just means that there's some interesting new cross conversations to have. I mean, so I'd say those are a couple of the places. I think the other place we've done a lot of work the last couple of years on housing affordability and housing security, and starting to look at the intersections between that and retirement savings, and just the way that so many more people are bringing debt into retirement. And so what we know, I think we need to stop and really keep our eyes open and ask questions about what does retirement look like in America today. I don't know if you saw the Oscar-winning show Nomadland that it won the Oscar this year as a movie.
Not yet, but yeah.
It's interesting to me. It helps people ask different questions about what we want people to have in terms of dignity and freedom in retirement. It brings the retirement conversation out of a stuffy pension conference room into how we're grappling with what America is and what it will be, and not everybody's there, but I think it's hopeful to me. And of course, the last part of that for us is, especially, it wasn't just COVID last year in the US, it was a real racial reckoning after the murder of George Floyd and Breonna Taylor, and the ways that those disparities show up in every system, but increasingly the way that we're aware of it showing up in the retirement system just adds further impetus to why we need to solve the access problems and why we need to look at the systems for equity.
Yeah. No, absolutely. One topic we've talked about before, Ida, and sort of done sort of sharing ideas on, but just interested to hear your thoughts now, is this whole issue around the self-employed and continued workers. So, those are groups who, for kind of very functional kind of practical reasons, kind of don't fall under the auto-enrollment framework here. And so, whereas we've seen kind of participation in retirement saving rise really rapidly among traditional workers, it's kind of continued to decline among the self-employed, even as more people have been becoming self-employed here. How have you guys, I mean, in the debate in the States about expanding access, and how far is that an issue, and are there kind of good innovative ideas that are coming out about how to include those groups rather than leave them on the outside?
This is when I'm going to make you the net exporter of ideas, Will. I think you're ahead of us on this. It's on people's radar screen. Even at the state level, when you think about how that's been able to engage small employers, it hasn't necessarily become policy that's applying to gig workers. And I think that, and then there's a lot of the focus in the US, a lot of the policy and kind of suits around that have been around, is what are, how many of the workers are misclassified, how many workers are really gig workers, how many, really should be dubbed, actual employees. Some of the state plans include part-time workers, some don't. So, there's like multiple levels of who is part of the policy here, and we don't have the answers to it yet. I think part of it for us pushes the bigger question that you are starting to hear from, not all, but I'm not making up that I'm hearing this more and more, which is people really questioning how much sense it makes going forward to base such critical access on the employer. So in the US, both your healthcare and your retirement savings are a fiduciary responsibility of an employer that can make a choice about that. But it's workers who need these things no matter where they go. So again, it speaks to the portability, and it speaks to what would it take to change the fiduciary responsibilities and the nexus of kind of like who is looking out. I mean, there's always going to be a trust from an employer. There's a trusted relationship there, but so much of the whole in retirement savings for us is in the small business place, because honestly, people already have, the business owner is already the HR person, is already the main salesperson. It's not for lack of wanting to do the right thing by employees often. It's just that there's a huge amount of legal liability and complexity and cost when you start to disaggregate the unit of coverage to a person or a small business. So I think technology can help us get there. I think we could solve this problem from a technology perspective for gig workers, for small businesses. I think that the conversation has to start at a much higher level about fundamentally rethinking the social contract and who plays what roles in that. We've done that in the UK in masterful ways with master trusts in Australia too. The role of the employer changes fundamentally, and that allows for broader coverage. And for me, I would turn it back to you. Where is your thinking going about where are the hurdles for you for gig workers getting covered? Because I think that you're closer to actually getting people to figure out how to address that than we are at this point. But it's another place where I think we'll have a lot to do together in coming years.
Yeah, and I think our kind of, our focus in this space has been on, I guess it's actually more what you might have been describing earlier around kind of portability and interoperability. So it's kind of how do you find the places in the system where the self-employed are earning their money or managing their money? Where are they getting paid? Are they getting paid through payments platforms like PayPal, for example? And then looking at those as the kind of nearest equivalent that we have to payroll deduction, which has worked so well in traditional workspaces and workplaces and trying to kind of find ways to mimic some of the features of a workplace setup, but in the places where the self-employed are earning their income. But I think that requires those platforms to view that as an opportunity and to want to innovate down that line, and that's that's a case that I think still has to be made a little bit for those people, but that's certainly where we've been focusing. So we have a couple of questions in from people who are listening in, so we'll run through a couple of those now, I think, just for the last few minutes, if that's okay. So the first is just kind of what from your perspective, Ida, or from Aspen FSP's perspective, kind of should a federal program look like around the retirement system? Like if there is going to be some kind of federal auto enrollment program, kind of what form should it take? What features would you hope that it would include?
Yeah. I mean, I'll say it from a perspective of, in some ways, just what's Ida think. I think Aspen, it's not like we don't have opinions. I think the principled area of universal is something, but at the end of the day, I think there's enough humility to realize that what I want our political leaders to prioritize and solve for this and I know that there's going to be trade-offs, and then there's not going to be a home run with a first pass of policy. But from the evidence and the design with the goal in mind of financial security, you want everybody in the system. So I don't think you get here without some kind of a federal across the board mandate that employers must split payroll, which is really what the mandate is. It's saying you must split payroll into these two places. And I do think that the mandate being on the employer and the employee having choice, we have so much to look at from you. So that feels critical to me. I think that what we probably won't get to at the first part here is what's the employer match on that. I think when I look at what actually it's taken to get to financial levels of accumulation in the UK and Australia and other places, you don't get there without a match. We have great tax incentives in the US but they're so regressive. The more money you make, the higher your tax rate, which means the higher your rebate when you save and get a tax break on your retirement savings. So a low-income saver, they don't even itemize. So they don't actually get a government incentive to save. So I think you have to be proactive as well at having a refundable credit where the government's helping match the savings of lower income workers to create some equity here. And I still think that we'll take more than that. And I think it's got to be portable from the start, and it's got to be worker centric. These are what I think some of the fundamental pieces are. There's legislation that is moving right now that solves for many of the tweak problems we have in our existing system. And there is also legislation that is bolder, calling for automatic enrollment, calling for a refundable credit, and calling for emergency savings. I don't think they're all going to come across the finish line together, but I don't think they're going away either. But a part of what we need is some of these people that have become real advocates and witnesses to the success at the state level. Maybe what it's going to take is political leadership, continuing to evolve and grow and have federal positions so that we can walk and chew gum in this country about what kind of problems we can solve.
Great, thanks, Ida. So good question here that's for both of us, which is what do we envy about each other's context? So what would I take from your system if I could? What would you take from ours? So you go first. You can take one or more aspects of the UK retirement or broader financial system. What would you have?
Well, I'm going to go from this is a non-wonky answer. I have plenty of wonky answers, but so my favorite thing about your system, the universality of your system, is what it has created in terms of a sense of our pensions. You know what I mean? Like when everybody has it, it actually becomes something you can talk about in society. And there's been a number of meetings that I've been at, meeting people at your conferences, and there's just a source of pride when somebody says, my nanny has a pension, or like anybody you talk to that's working in a restaurant or anything. Everybody has a pension. There's a way that it's a source of it. You can't talk about it in the US because half the people don't have it sometimes, right? So it's like, so anyway, that's a weird, quirky thing to say, but I'm envious of that because I think you build a lot of shared identity from something as simple as having a universal pension plan. Now you go.
Yeah, I'll go. I was going to say that it's really interesting to hear you say that because I've said something similar in the past about some of the European systems. That I wish we had. In the Netherlands, they talk about the pension system all the time, just every day on the street. It's like an actual topic of conversation, which I think is extraordinary, and we don't have anything like that. But it's interesting to hear you say something similar about the UK. I guess from my perspective, I mean, a couple of things. I think on the non-pension saving side, like the sort of market around the workplace and workplace financial well-being is just a lot further advanced in the US than it is here. I think there's been a lot more kind of both demand from employers, and also as a result of that, there's a more mature kind of supply side thinking about kind of how, what does kind of innovation around employer and employee benefits look like around financial well-being. And so things like, and we've talked about this a few times as an example in some of our research publications, but things like the Abbott Labs example where they've taken, where they're offering an employer match pension contribution to support student loan debt repayment among their younger workers. Like, I think that kind of thing is, like, we haven't seen that kind of innovation yet here in the same scale. So I hope that's going to be the next idea that you guys export to us, or the next kind of set of thinking that you guys export to us, especially as we think more about our own kind of emergency savings work and the kind of innovation in workplaces around that. And then I think the other thing, when you mentioned this earlier, and we talked a bit about it in the, when we were discussing this session, I think just in the last kind of probably couple of years, but there's a much more advanced and mature debate in the US about the racial and ethnic dynamics of financial well-being and retirement saving than I think we've got to here yet. There's just not as much data, but there's also not the same almost, I feel like when I'm talking to people in the States, there's a really healthy obligation to include that as part of the discussion and think about how solutions are going to affect people from different backgrounds and in different kind of parts of the system. And I'd like there to be more of that here. I think we haven't kind of got there on some of our debates around the system here yet. And then really selfishly, as someone running a research unit, I wish we had the same maturity of philanthropic research funding in the UK as you guys have in the US. All these privately owned foundations with their billions.
Yeah. Anybody's listening in that regard. I mean, I've seen Will's team in action. Your ability to pilot things. You have 9 million savers now in the UK, and your ability to do some of the most interesting applied research, that is completely 100% utilizable by people in the US about how we design. The more resources you have to do work, the better off we all are. So I hope that really, as I'll keep trying to open those doors, because I think you guys are really asking some of the most important and interesting questions, and trying to push and are doing a good job of pushing the conversation in the UK. I think it is and it isn't as far along in the US, either on the innovation side or on the racial equity side. Obviously, part of for instance, we had a great dialogue. We do the Aspen Leadership Forum on retirement savings, which you've been a part of, and the final dialogue that we did this week, that I sat on the very same patio to do, was on racial equity in the retirement system in the US. And it was a super, we've done this for a couple of years now. We've really started to try to make explicit the conversation about that. I've been amazed in the past year in the US, all of the different corporate commitments to racial equity. After last summer, there was a real line in the sand. There's a real outpouring that we must do more in the US. And then when you look at the solutions that people are signing up for, they're all super important. We're going to make sure that our supply chains are diversified. We're going to diversify talent pipelines. We're going to put some of our profit and our core operating in Black-owned banks. There's a lot of really interesting systemic pieces. Nobody in those corporate commitments has said anything about the retirement savings system yet. And yet, when you look at where net worth resides on the balance sheet, it's home equity and it's retirement savings. That is where anybody in the US, only 60% of people in the US have any kind of account in a capital market. And the majority of those people, they only have it through the retirement savings system. So if we want to think about the racial wealth gap in America, we've got to center the retirement savings system as a big part of that solution. And it's just beginning to occur that frame about the future of wealth and a racial wealth gap should actually be used as a lens for how we think about the retirement savings system and its potential to do so much of the equity work that we need to do in this country. So, I'm hoping that also creates momentum for what people because that's the issue in the US. We don't have a pensions minister. We have, and to the degree that we talk about retirement savings policy, it's usually in the context of the tax code. We don't really have a robust multi-stakeholder conversation about retirement policy. We certainly don't have a Netherlands conversation. but I think we can change that. And I think that the ways that you continue to do cross-cutting research and the way that we continue to put the pieces of somebody's financial life together means that more and more different kinds of companies, both financial services and otherwise, see the centrality of this issue as something that they can be a part of the solution in. So that makes me hopeful.
Great. Ida, that feels like a great place for us to draw things to a close. So I want to say thanks. It's always absolutely brilliant speaking to you and hearing what you have to say. So we're really grateful for you making the time to join us today. A couple of quick plugs from me to those listening. One is just to say, please, kind of look out for the work that we and Ida's team will continue to do together. Some of the things Ida mentioned around student debt, housing, the interactions of other kind of named bits of people's financial lives and how they interact with the retirement saving and emergency savings. These are areas that we're going to be doing more work on together and talking about more together over the coming months. So keep a look out for that. But for now, thanks everybody so much for joining us. Thanks again, Ida, for joining us. We've had a really great discussion. I've really enjoyed it and look forward to speaking to you again soon.
Yeah, it was great to see you, Will. Take care.
Thank you. Thanks, everybody.